The best way to learn accounting, finance, and valuation. Investment is the key to your financial freedom. Valuation is the basis of any rational investment. If you want to buy a stock, you need to understand the intrinsic value of the underlying business. If you want to buy a property, you also need to estimate the value of the property. Here we will introduce the most critical and practical concepts and knowledge to help you understand accounting, finance, and valuation, so that you can make good investment decisions. But before that, you should have some basic knowledge about math. You can review all the important math concepts in one of our playlists called Math and Competition. Now, let's start. Accounting is the process of keeping track of all financial transactions within a business. There are primarily 5 branches of accounting. Financial accounting is to record transactions and prepare financial statements according to generally accepted accounting principles, or GAAP. Cost accounting is to evaluate and minimize costs. Tax accounting is to minimize tax and file tax returns. Management accounting is to collect, analyze, and present data for decision-making. Auditing is to evaluate the internal control and verify the financial statements according to GAAP. In the end, you need to understand the major items in the financial statements for valuation purposes. There are 6 important concepts in accounting: assets, liabilities, equities, income, expenses, and profit or loss. The asset is an item you own that has financial value or is expected to have financial value in the future. In short, an asset has to produce income in the future. For a person, an asset may be your house, cars, bank accounts, and collections. For a business, there are quite different assets, like buildings, machines, cash and securities, inventories, etc. Assets are the most important parts for valuation. Usually, they have to be accounted for by using historic costs, like purchasing price or building costs, etc. However, things may change drastically. For example, the price of a property can go through the roof during a bull market, and crash to the floor during a bear market. The same applies to inventories, securities, investments, and other assets. Sometimes, a company may partially own other companies, which may experience major business changes. This could have big impacts to the market value of the investments. According to its liquidity, assets can be classified as current assets and non-current assets. Current assets are cash and other assets that are expected to be converted to cash within a year. Current assets include cash, cash equivalents, accounts receivable, inventory, marketable securities, and other liquid assets. The current assets account is important because it demonstrates a company's short-term liquidity and ability to pay its short-term obligations. Non-current assets are long-term and have a useful life of more than a year, like long-term investments, land, property, plant and equipment, and non-tangible assets, like patents and trademarks. Assets which are purchased for long-term use and are not likely to be converted quickly into cash, such as land, buildings, and equipment, are also called fixed assets. Non-current assets can have depreciation or amortization components. Depreciation is the expensing of fixed asset as it is used to reflect its anticipated deterioration. Amortization is the practice of spreading an intangible asset's cost over that asset's useful life. Those depreciation or amortization methods can be subjective and may not be appropriate, which can cause some valuation discrepancy. Goodwill is a very special non-current asset, which is created when a company buying another company with premium. During a stock bull market, the premium can be hefty, and the goodwill could be huge. However, under a stock bear market, most of the goodwill may be written off. Warren Buffett always buys assets or companies when the value is low due to market environment. Either for current or non-current assets, you need to understand the true value, not just the amount listed in the financial statements. Warren Buffett always says he only invests in simple businesses. What a simple business means the assets are easy to understand and evaluated. The next concept is liabilities. Liabilities are obligations of the business that may need to be paid back over a period of time. These would include both short-term or current liabilities such as accounts payable, and long-term liabilities such as loans and mortgages. Liabilities are much easier to understand than assets. You owe somebody. You have to pay back. It's just as simple as that. Equities are claims by owners of a business on its assets after all debts have been paid off, primarily including common stock and preferred stock. Accumulated Other Comprehensive Income, or AOCI, is a special equity item, which includes unrealized gains and losses on certain types of investments, pension plans, and hedging transactions. Higher AOCI means higher uncertainty to valuation. Once you can understand assets, liabilities, and equities, you can read a balance sheet, one of the three important financial statements. The balance sheet provides an overview of assets, liabilities, and shareholders' equity as a snapshot in time. The next three important concepts are income, expenses, and profit or loss. Income is money that the company makes from its regular business operations before accounting for expenses such as taxes, interest payments, and other financing activities. Accrual basis accounting recognizes business revenue and matching expenses when they are generated, not when money actually changes hands. Expenses are reduced from total income to derive the net profit or loss of the business. Profit means you make money, while loss means you lose money. Profit or loss can also be called net income. All businesses want to make profit. They need to increase income and reduce expenses. All successful businesses acquire big markets and provide most desired products and services. They make big income, and it's growing fast. So one key factor for valuation is looking at the growth rate. Just like a person, expanding income is always preferred rather than controlling the costs. Many times, the costs are already optimized, and there is not much space to reduce the expenses. So where the income comes from? It's from product design and marketing. It's from strategic planning and management quality. It's from client service and customer satisfaction. All those factors cannot be accounted for by accounting numbers. But you need to consider all those factors for valuation purposes. Once you can understand income, expenses, and profit or loss, you can read an income statement, another of the three important financial statements. The income statement primarily focuses on a company's revenues and expenses during a particular period. Once expenses are subtracted from revenues, the statement produces a company's profit figure called net income. The income statement has many steps. Total revenue minus cost of revenue becomes gross profit. Gross profit has to be positive. Otherwise, the business can't make any money. Gross profit minus operating expenses, like selling, administrative, research, and depreciation expenses, becomes operating income. If gross profit is positive but operating income is negative, the company needs to cut costs and reduce unnecessary expenses. Operating income minus non-operating income or expenses becomes pre-tax income. Those items, such as profits or losses from investments, as well as gains or losses incurred by foreign exchange and asset write-downs, are usually one-off, and should be separately considered during valuation process. Finally, pre-tax income minus tax becomes net income. Net income could be manipulated. Profit or loss could just be a simple adjustment. Due to the easy manipulation of net income, companies also need to provide the last of the three important financial statements, called cash flow statement. The cash flow statement measures how well a company generates cash to pay its debt obligations, fund its operating expenses, and fund investments. Cash flow is always the actual cash received or paid, and cannot be manipulated. So it's considered more close to business reality. There are three parts for a cash flow statement. The operating activities include any sources and uses of cash from running the business and selling its products or services. The investing activities include any sources and uses of cash from a company's investments in the long-term future of the company. A purchase or sale of an asset, loans made to vendors or received from customers, or any payments related to a merger or acquisition is included in this category. Cash from financing activities includes the sources of cash from investors or banks, as well as the uses of cash paid to shareholders. Financing activities include debt issuance, equity issuance, stock repurchases, loans, dividends paid, and repayments of debt. There is an important concept called free cash flow, which represents the cash that a company generates after accounting for cash outflows to support operations and maintain its capital assets. Free cash flow reconciles net income by adjusting for non-cash expenses, changes in working capital, and capital expenditures. This is the company's available cash repaid to creditors and as dividends and interest to investors. Now you understand all the important concepts in accounting.